In 1998, a single hedge fund came so close to destroying the global financial system that the Federal Reserve called an emergency secret meeting to bail it out. This fund wasn't run by reckless gamblers or fraudsters. It was run by two Nobel Prize-winning economists, a former vice chairman of the Federal Reserve, and some of the most brilliant mathematical minds Wall Street had ever seen. They had a model, a perfect model, a model so sophisticated that banks and investors handed them over $100 billion to manage. And then, in 4 months, they lost nearly everything. This is the story of long-term capital management, the smartest fund in the world, and how its genius nearly became everyone's catastrophe. It started with a man named John Meriwether. In the 1980s, Meriwether built one of the most profitable trading desks in Wall Street history at Salomon Brothers. He recruited PhDs, mathematicians, and economists, people who believed that financial markets could be understood through equations, not instinct. When Meriwether left Salomon Brothers in 1991 following a Treasury bond trading scandal, he didn't retire. He built something bigger. In 1994, he launched Long-Term Capital Management, LTCM, out of Greenwich, Connecticut. And the names he recruited were extraordinary. Myron Scholes and Robert Merton, two academics who would go on to win the Nobel Prize in Economics in 1997 for their work on options pricing theory. David Mullins, the former vice chairman of the Federal Reserve, and a team of quantitative analysts whose collective IQ was probably the highest ever assembled in a single trading room. The pitch to investors was simple. We have a model that identifies tiny price discrepancies between related financial instruments. We exploit those discrepancies at enormous scale. The returns are steady, consistent, and almost mathematical in their certainty. Investors believed it. In its first year, LTCM returned 28% after fees. In 1995, 59%. In 1996, 57%. The money flooded in. By 1997, LTCM was managing $7 billion in investor capital and controlling over $100 billion in assets through borrowed money. That ratio, $7 billion in equity, controlling $100 billion in assets, is called leverage, and it would become LTCM's fatal flaw. So how did LTCM actually make money? The core strategy was called convergence trading. Here's the basic idea. In financial markets, similar assets sometimes get temporarily mispriced relative to each other. LTCM's models identified these gaps and bet that the prices would eventually converge, move back toward each other, and collected the difference when they did. For example, if a 29-year U.S. Treasury bond was trading at a slightly different yield than a 30-year Treasury bond, LTCM would bet on the gap closing. These gaps were tiny, fractions of a percent. But at enormous scale, with enormous leverage, tiny margins became massive profits. The models were built on historical data, and historically, they worked. But here was the blind spot, and it was a big one. LTCM's models assumed that markets behave rationally, that extreme events are rare, and that different asset classes don't all move in the same direction at the same time. What the models couldn't account for was this. What happens when investors around the world panic simultaneously? What happens when everyone tries to sell the same things at the same time, and the normal relationships between assets completely break down? LTCM was about to find out. In August 1998, Russia defaulted on its government debt. It wasn't entirely unexpected. Russia had been financially unstable for months, but the shockwave that followed was bigger than almost anyone anticipated. Investors around the world panicked. They didn't just sell Russian assets. They sold everything risky and rushed into the safest investments they could find, primarily U.S. Treasury bonds. This is called a flight to quality, and it happens fast. For LTCM, this was catastrophic. The fund had made bets that assumed various asset prices would converge. Instead, they diverged, violently. The gaps LTCM had bet would close got wider, and wider, and wider still. Every single day, LTCM was losing hundreds of millions of dollars. In August 1998 alone, LTCM lost $1.9 billion, nearly half its remaining capital. By September, the losses were accelerating. Banks that had lent LTCM money started calling their loans. The fund was being squeezed from every direction simultaneously. And here was the truly terrifying part. LTCM had borrowed money from almost every major bank on Wall Street. If LTCM was forced to liquidate its positions, to sell everything at once, the sheer scale of the selling would crash markets globally. Pension funds, retirement accounts, and ordinary investors around the world would feel it. LTCM had become what's called systemically important, too interconnected to be allowed to fail without consequence. On September 23, 1998, the New York Federal Reserve called an emergency meeting. They gathered the CEOs and representatives of 14 of the world's largest banks and financial institutions in a room and told them the situation plainly. LTCM was on the verge of collapse. If it went down in an uncontrolled failure, the consequences for global markets could be severe and unpredictable. The Fed didn't use public money. Instead, it orchestrated a private bailout, essentially forcing the banks to collectively inject $3.6 billion into LTCM in exchange for 90% ownership of the fund. The existing investors were nearly wiped out. Merriweather and his team stayed on to manage the wind down. Over the next 2 years, the positions were carefully unwound. By 2000, LTCM was closed. No public funds were used. No executives went to prison. There was no fraud in the traditional sense. LTCM had simply made enormous bets using borrowed money, been wrong about how markets would behave in a crisis, and nearly taken the global financial system down with them. That last part is what makes LTCM so important. It wasn't a scandal. It was something arguably more dangerous, a legitimate, legal, Nobel Prize-endorsed strategy that failed catastrophically because the people running it believed their models more than they believed in the possibility of being wrong. The LTCM collapse in 1998 should have changed everything. And in some ways it did, for about 10 years. Regulators talked about systemic risk. Economists debated leverage limits. Academics wrote papers about model risk and the danger of over-relying on historical data. But the core lesson, that smart people using sophisticated models can be catastrophically wrong when reality stops behaving like the past, was largely forgotten. 10 years later, in 2008, the same dynamics played out again. Different instruments, different institutions, same fundamental mistake. Too much leverage, too much faith in models, and an assumption that extreme events don't really happen. The LTCM story is a warning that gets ignored, generation after generation, because the people involved always believe they're smarter than the last group that failed. As the economist John Kenneth Galbraith once observed, financial genius is before the fall. Long-term capital management had 2 Nobel Prize winners, a former Federal Reserve vice chairman, and the most sophisticated financial models of their era. And they still almost took down the world. That's the thing about financial markets. They don't care how smart you are. They care whether you're right. If you found this case study interesting, subscribe to the Case Study Lab for a new corporate fraud and collapse breakdown every week. And if you want to go deeper, check out the full playlist for more stories like this one. I'll see you in the next one.